You spend years studying, passing exams, and following the traditional roadmap to success. Walking across the stage is supposed to be where life finally begins. But for millions of graduates, the diploma arrives with a price tag that outlasts the career it was meant to launch. The Certificate of Achievement is tied to a financial obligation that begins the moment the lights go down. We are looking at tens of thousands of dollars in high-interest debt, often handed to people before they've earned their first professional paycheck. Because these loans are almost impossible to discharge in bankruptcy, they can follow a borrower into their 50s and 60s. Leaving the graduation stage today often means entering a financial landscape where the traditional markers of success are hidden behind a wall of high-interest leverage. In the 1970s, the financial stakes of a degree were manageable. A student could often cover a year's tuition by working a summer job, graduating with a clean slate and a direct path to the middle class. As costs began to climb, society's expectations shifted. We moved from a model where education was a public investment to one where mass personal debt became a standard, unquestioned entry fee for adulthood. Lending large, unsecured sums to 18-year-olds with no assets or income is a strategy that defies typical banking logic, yet it became a routine part of the American experience. This shift turned a path to opportunity into a mandatory toll road, where the price of admission is a decades-long commitment to debt servicing. The rapid increase in tuition is a direct outcome of specific institutional incentives. It starts with the federal government, which removed market friction by issuing blank check guarantees for student loans. When the state guarantees a loan, the lender no longer faces the risk of a borrower defaulting. This creates a moral hazard where there is no incentive to limit the size of the debt being issued. Banks saw an opportunity for risk-free profit. They could issue massive loans to teenagers, secure in the knowledge that the federal government would backstop the balance if the borrower couldn't pay. Universities reacted to this influx of guaranteed capital by raising prices. When the customer has access to nearly infinite credit, the natural market pressure to keep tuition affordable disappears. Much of this tuition money funded an era of administrative expansion and high-end campus amenities. These facilities were designed to attract more students, who in turn brought more guaranteed loan capital with them. These three institutions, the government, the banks, and the universities, each optimized for their own gain, creating a system where costs rose as the risk was shifted entirely onto the student. For the individual, the result is a steady drain on monthly income. Money that would normally support the broader economy is diverted to debt maintenance. This drain is most visible in the housing market. High debt-to-income ratios prevent many graduates from qualifying for mortgages, delaying the ability to build equity and participate in the primary driver of American wealth. These financial pressures lead to a measurable delay in life milestones, including marriage and the ability to start a family. Compounding interest is a trap where early payments fail to cover interest. Many find years later their total balance increased. As the gap between earnings and debt widens, the ability to invest is lost. Generational wealth is consumed by interest. This environment has created a structural barrier for a generation of educated citizens, making the traditional markers of adulthood harder to reach than for any generation before them. When millions of citizens are forced to limit their spending to service debt, the impact moves beyond the individual and into the wider economy. This affects the velocity of money. If wealth is captured by debt servicing, it cannot flow into new businesses or goods. Economic growth relies on young people starting companies and buying homes. When those engines stall, friction is felt across every sector. Student debt now acts as a trillion-dollar bottleneck on the very consumption and investment that drives the national GDP. We look back at the graduation stage, where youthful optimism meets a system designed to extract value from their pursuit of a better life. Higher education was intended to be the great American equalizer. Instead, it now frequently functions as a barrier, widening the gap between those who start with wealth and those who must borrow it. This reality forces us to ask if the pursuit of knowledge has become secondary to the management of its financing. Has higher education become one of the most expensive, broken promises in America?